In this unit, we are going to talk mainly about the difference between management cost accounting and financial accounting. First of all, we have to know what is a productive activity. It is any economic activity that generates added value or any process that increases the utility of an economic asset. In each productive activity, we have an operating cycle. Flow of costs refers to the manner or path in which costs move through a firm. Typically, the flow of costs is relevant with manufacturing companies whereby accountants must quantify which costs are in raw materials, in work in process, finished goods inventory, and cost of goods sold. Flow Now we are going to see the difference between financial accounting and cost accounting. Financial accounting is the process of preparing reports about business operations that help managers to make short-term and long-term decisions. It helps a business to achieve its goals by analyzing, reporting, and interpreting the information to managers. Now, we also have to know that activity-based costing is a cost accounting system that allocates manufacturing costs based on production activities, and cost pools represents the indirect costs from each activity that affects the activity-based costing process. The most common cost pools in our system are mainly three: manufacturing overhead, indirect materials, and indirect labor. While each item is necessary to produce goods and services, the costs for the items are not directly necessary to make an individual product. We also
Okay, so now we're going to talk about the income statement. The income statement is calculated step by step, facing positive flows, which are revenues, against different costs grouped by functions, obtaining different margins or partial results with its analysis degree helps facilitate a more adequate information for its pursued aim. However, just before carrying out this confrontation between revenues and costs in the structure of the income statement, there has to be a clear content. In this management accounting, what is for interest is the maximum possible detail, being the result calculated by differences between revenues and costs strictly derived from the exploitation cycle that constitute the principal object of the company's activity. This means overall that if a company often develops different simultaneous activities, distinct exploitation cycles should be separated and consequently as many functional exploitation accounts as necessary will be elaborated as different exploitation cycles have been established. So here we have the income statement, the most reduced table, which will have net sales, cost of goods sold, gross margin, and then minus the selling cost, we obtain the commercial margin, minus the administrative and financial cost, we obtain then the result we want, which is the net income. Then in the following table, we have a more developed one, which is the same as the other one, but just more developed, and the final result is the one we want, which is the net operating income. So we have the net sales calculated, and then like more steps that are all calculated before in the cost statistics, which is to calculate the cost of the goods sold. So we have the direct material consumption plus direct labor, direct cost, manufacturing overhead, plus the work in progress, beginning inventory minus the end inventory. And then we have to sum up the final good in beginning inventory minus the final good ending inventory, and we got the cost of goods sold. And then we have the gross margin, and then it is the same as the same table before, and we obtain the net income. Then finally, in order to have losses and profits coincide calculated in financial accounting with the results balance of management accounting, this following table should be made. So we have then the net operating income, which is the one we had in the last table, minus the finance cost, and then we obtain the net income, which is what we're looking for in the income statement. So plus minus recurrent activities, normal income, and then finally dividends, which is the result we want to obtain in the final step.
Well, I'm going to talk about internal and external income. First of all, we have to make a distinguish between recurrent core business, recurrent non-core business, and non-recurrent extraordinary. Well, the main difference between them is that in the first one, recurrent core business, they are directly related to the main manufacturing process and it's occur regularly. The second one, recurrent non-core business, they occur regularly and they are not related with the main business. And in the last one, non-recurrent extraordinary, they are not related with the core business and also it doesn't occur regularly. Internal income evaluates the efficiency of its company use of resources in its manufacturing process, and it follows an economic criteria, while in the other hand, external income, it is calculated because of legal requirements and it follows a legal criteria. On the other hand, in the analysis, we have to distinguish between costs that are not real expenses and real expenses that are not costs. In the first one, there are costs that do not imply cash disturbance. This means that there are no transactions with third parties. Some examples of these are interest of capital invested and entrepreneur salary. And on the other hand, in the real expenses that are not costs, there are costs that they are not related with the core business. Well, now we have some definitions. Income, which is the difference between sales and the sum of CGS plus selling cost. Margin, which is the difference between sales and cost. Cost, which is the summary of consumptions regarding a product or service in some point along the manufacturing process or a function of the company, either real or specifically created for accounting purpose. And CGS plus the distribution cost, which is the summary of all consumptions regarding a product or service one delivery to customers. And a product has different costs but only one cost price.
Okay, we will continue explaining the case 2.5 of the unit 2 and we will focus on the most important point. I will explain the evaluation of the ending inventories and after that how to calculate the unit cost of product. I will assume that all of you are able to allocate the indirect cost. Okay, first of all I will start explaining the direct material consumption. The first thing that we have to know is that we are working with FIFO. So if we have a beginning inventories and a purchase, and we have a total amount consumption of 3,000 kilos, as we see here, first we will consume 1,000 from the beginning and the rest from the purchase. So by this way, the total here are 5,000 kilos and here 3,000 kilos. The rest will be 2,000 kilos at this last price. Okay, now I will explain how you get this price. This price comes from the acquisition cost that you are adding all the acquisition cost, all the cost that you had, and also you are adding the purchasing cost are 350 euros that came from here. You have to do the indirect cost allocation chart. You have this value, this figure, and you know that come from here, that you see here that that amount is for A and the rest will be for B. So you have there that amount and the rest for B. Okay, you have to know this value. Okay, so multiplying these values we obtain the total consumption. Here the ending inventories. Okay, now respect the product X. We have a beginning inventories that we can see on the balance and enough manufacture of 1,000 units per a price of 5.05. This value, this amount of this unit come from here, the cost of the goods manufactured that my teamwork will explain later. Also we see that we have in total 1,200 units and we have a consumption or a sales amount of 1,100 units. The ending inventories are 100 units at a price of 5. Why at a price of 5? As we see, we obtain it here by adding all these cost per product per price. This is the amount per price, and here is just the total amount. So we have this value, and the same for the product zeta. Okay.
Well, we are going to talk about the income statement that we are going to explain quickly. First, we have to obtain the direct material consumption for direct material A and product X. We have to multiply 2000 that we obtain it from 0.5 times 1.1, as it is the weighted average of direct material A. We have to do the same with the other three figures, and we obtain the final direct material consumption. In case of direct labor, we obtain it from 0.9, that it says direct labor is 1,000 euros, and at the end of the exercise we obtain that 70% of direct labor is for product X and the other 30 for zeta. Then we have to calculate manufacturing overhead that we obtain from the indirect cost allocation chart, that it says it is 1,150 euros, and at the end of the exercise it also says that 70% for product X and 30% for product zeta. We add these three figures and we obtain the manufacturing cost. Then we have to add and to deduct the beginning and ending work in process inventory to obtain the cost of goods manufactured. As for the net sales, we obtain it from 0.6, and we have to deduct the discounts and the returns. In case of zeta, in 0.7 it says it has a 50 euros of discount. Then we have to obtain cost of goods sold, that we obtain adding and deducting from to the cost of goods manufactured the beginning and the ending finished goods inventory. Finally, to end with this both division, we have to deduct to the net sales the cost of goods sold. Then we add these two figures and we obtain the gross margin total, the total gross margin, deducting to it the selling indirect cost that we obtain in the indirect cost allocation chart to obtain commercial margin. And finally, we do the same with the administrative and financing to obtain the final net income, that is the solution we were looking for.